My colleague Emily Maitler has put those arguments to our guests, Nassim Nicholas Taleb, author of The Black Swan, Professor Kenneth Rogoff, former chief economist of the IMF, and Dr. Linda Yu, Oxford University. Let's take a look at that discussion now.
Nassim Nicholas Taleb, a lot of people are now saying we should have seen this coming. Could we, really?
Yeah, the banking system for 12 years has been building risks on things we don't understand based on bogus economic models, financial economic risk management tools. That was unacceptable. We were in a plane flown by pilots who didn't know what's going on. Eventually that plane would crash.
Kenneth Rogoff, were you one of those who ignored the message?
I certainly don't think so. I think I've been certainly railing against the excessive U.S. borrowing for some time. The U.S. current accounts, which are the trade imbalances, the U.S. is borrowing so much money that really lies at the root of this problem. Frankly, I think many economists had been warning about this. Many of the central bankers had been warning about this. But it's very, very difficult politically in an environment where everything seems to be going up and you seem like a spoil sport.
Linda, you, as an economist, is it possible to integrate a model, a market model, with risks of the unexpected?
It's virtually impossible. I mean, exogenous risks are actually the things that we don't know. But there were things that we did know. I mean, if you look over the past decade, what has changed, of course, is the global structure of the global economy. So what Ken Rogoff was saying, and indeed was that, you know, we essentially had is the growth of, say, emerging economies with huge amount of surpluses, pushing down inflation in the West, as well as buying treasuries and funding Western debt. So that allowed countries like the U.S., like the UK, with a low savings rate to be able to borrow cheaply and have low inflation. I mean, and that's one of the ingredients of allowing mispriced risk to happen.
Kenneth Rogoff, isn't that the point that actually, for example, in 2001, the dot-com bubble, instead of just saying, yes, we'll let that burst, we'll let that go to the ground, what did Alan Greenspan do? He cut interest rates and the thing was refueled. Was that the mistake?
Well, I don't know that they made a mistake exactly then, but they certainly, along the way, weren't willing to let output slow down a little. So there's no question they kept interest rates too low for too long. It's a lot of factors. It's not just monetary policy. It's also has to do with the policies in the Asian countries. They were allowed to keep their exchange rates too low and to intervene too much in the exchange rates. There are a lot of things going on.
Okay.
But certainly mistakes were made after the 2001 tax bubble.
Well, let me ask you, three great minds here tonight. I'm sure there are a lot of minds in Washington saying we've got to get away from ideology and sort out policy. What would be your answer to that, Linda?
I think we do need to have a coordinated response, because the truth is financial markets, institutions and banks cross borders. So you have to have stability and confidence in the system. So what they need to say is much along the lines of what the UK bailout plan is, and actually the US bailout plan: recapitalization, injecting liquidity and putting the government behind not just the money markets but actually depositors, because ultimately that is what the financial system is built on.
Isn't the trouble that you can't ever see the unpredictable?
Let me start from scratch. I worked for a long time as a trader. My fight was with people who claim they can understand the probability of an event happening, a rare event, particularly when they know theory, economic theory. So they give you a probability of something happening, losing more than X million dollars. So these banks, comforted by these bogus measures of risk, were taking huge amount of risks.
What do you do now? Immediately,
I would suspend something called value at risk, quantitative measures of risk used by banks immediately. Okay, I would stop anyone from using methods called mean variance. They got a Nobel for it, by the way. Markowitz mean variance, all that nonsense for risk allocation. I would stop Fidelity Investments from disclosing something called risk of portfolio, quantitative measures of risk of portfolio, okay, to their clients who may not understand what it means, that it's a bogus measure. What we have here is a reliance on bogus measures that led us here. Okay. I am infuriated.
And Kenneth Rogoff, as the chief economist at the IMF for all that time, do you accept that there were bogus measures, that you were carried along on something that couldn't possibly exist?
I think this is just completely beside the point at the moment. I agree with what Linda said, that they need to worry about backstopping the depositors. There is an old-fashioned financial panic going on inside our gold-plated financial system.